Good morning, everyone. David Moore, Equity Advantage, IRA Advantage. We're gonna get going here. Actually, it's about time, so we'll get going right now, and I'll have some fun. Hopefully, you guys have some fun too. Get you some information that's going to help you do some deals, whether you're the investment side or you're a broker. So this is something, nothing we're talking about today is actually new. I mean, self-directed accounts have been available since the inception of retirement accounts in the mid-70s. It's just one of those things that's a very well-kept secret. So we're going to talk about creating the accounts. We're going to talk about what's involved with putting a real estate deal together, make a property acquisition, and sort of the timelines involved. And this is one of those situations where it's really critical that you plan things out and get yourself set up and ready to go before you go find what you want. Because inevitably what happens, people will call up and say, hey, what do I need to do to get this account set up to go buy this property? And we tell them, and I don't hear from them until they've got some property in their crosshairs, and now we're in a time crunch, and it's going to take you 2 to 3 weeks to put the account together. So it's really critical that we put the thing together before you move forward, because you can't just tie up a property and then assign that purchase sale agreement over to the retirement account. That would constitute a prohibited transaction. So if you've been on my presentations before, you know I have a tendency to get excited, speak pretty quickly. We're going to cover a lot of information in an hour. My objective is to give you some little nuggets of knowledge, also, get you to a point where you understand you sort of need me for the details. But we'll have some fun. If you got questions, I doubt I'll probably get to them during the presentation. We'll address any questions you've got afterwards offline, and happy to do so. If you've got questions on things that weren't covered, your suggestions for presentations in the future, please don't hesitate to let us know that too. We're always looking for ideas for content. My name, as I said before, is David Moore. My brother and I founded a company called Equity Advantage in 1991 to handle tax deferred exchanges. We put IRA Advantage together about 15 years later, somewhere in there, and that was a result of our 1031 clients honestly expressing their desire to take their retirement accounts, go buy more property. So it was sort of funny when we got into this side of the business. You go to a class on self-directed retirement accounts, and typically that class was all about just selling you the investment that was there and not really how to do it. So we're going to dispel some of the falsities in this space. We're going to talk about sort of what to do, what not to do, best practices, and give you a couple examples at the end. So thank you so much for joining us today, and we're going to get started right now. The bottom line, any IRA can become self-directed. Any IRA can be self-directed. If we're talking about it, if you're a real estate broker on this call and you're wanting to do this type of transaction, I'm probably not going to use a self-directed IRA for you if you're self-employed without employees. I'm probably going to send you in the direction of a solo 401k or a solo K instead for a variety of reasons. But we're going to talk about 401k plans. We're going to talk about IRAs and your ability to use both of those things to go do what you want to do. Now, as I said, any IRA can be self-directed. If we're talking about 401k plans, we can roll 401k plans into IRAs in certain situations. If you're happily employed and you're under 59 and a half and you want to use your current 401k plan to do this, unfortunately, we're not going to be able to help you. Now, if you cease to be employed, they're changed jobs, then you're going to have access to that money. We can roll those funds into either another plan or an IRA if that's that vehicle that we're going to be using in your situation. So as I said, any IRA can become self-directed. We're talking 401k plans under 59 and a half, current employer plan, you're stuck. As soon as you hit 59 and a half, you can go do what you want with that plan. And as I said before, if you're transitioning between jobs, we can then self-direct at that point. Now, I did have an example, not an example, an occasion, an occurrence a number of years ago where we had a gentleman that came to us, wanted self-direct. And as I said, it takes 2 to 3 weeks to get this thing together. And he had ceased to be employed with one company, and that was the opportunity to self-direct. Well, he went out and took a new job with another company before the account was established, and the new company was the same parent, had the same parent company, the old one. The plan was the same plan, so we were stuck in that situation. So, really, I think, if anyone on this call scuba dives, what do they tell you in a problem situation? If there's something that's giving you some heartburn, you don't want to panic. You want to just stop. So my advice is, in these situations, really, think about what you're doing, plan ahead, and work to get there. And if we're getting up over the tips of our skis on stuff, we need to back off, make sure we're set to go do what we want to do before you go and jump into this space. So as I mentioned at the very beginning, even writing a purchase sale agreement, if you found a property today and you didn't have the account established and you wanted to go write that offer to go buy that property, you personally can't write it if your retirement account's ultimately going to be the owner. Because if you write the offer, you take the property off the market, there's a benefit to the retirement account for doing that, and therefore it's a prohibited transaction. And so we don't want you to do that. If you've done that, you probably want to get that deal entirely torn up and then start over, and that way you're not going to have that situation occur. So something I will caution you on is, if you've got a Wall Street IRA or 401k, all your funds are in Wall Street, you can make a poor investment decision, but you really can't create a prohibited transaction. In a truly self-directed space, you have the keys to the kingdom. You have the ability to screw up. So it's really important. There's no guardrails there. You really need to think about what you're doing before you ever step into something. And we're going to talk about breaking it, boiling it down to the bare basics and what's involved with that. But this frame just talks about what it's going to take to get into the account. And something I will mention, as far as migrating IRA money into a 401k plan, we can deal with most simple SEPs, all those basics, but we cannot move Roth IRA money into a 401k plan, nor can we move an inherited IRA, what's called a beneficiary IRA. We cannot move those funds into a 401k plan. So depending, any IRA can be self-directed. When we're talking about 401k plans, there's some other little fine nuances we have to look at there. So I like simple. I speak quickly. I'm going to give you a lot of information, but I like to boil things down to the bare basics. If this was a class on 1031s, I'd talk about the 4 cornerstones. There's 4 issues I'm concerned about with a 1031 exchange. 1, it's got to be an exchange. 2, what's going to receive have got to be like kind. 3, you've got to satisfy what we call the napkin test, which says you're going to cross her up in value and equity. And finally, we have to have continuity of vesting. The taxpayer that gave us something has to be given something back. When we're looking at retirement accounts, I've got 2 issues. So half as complicated, right? 2 issues with the retirement accounts. What do you want to buy? And who are you transacting between or for the benefit of? Those are the 2 issues. And with respect to the investments, it's virtually limitless. And the way the law works with what qualifies for an IRA 401k, if it's not specifically prohibited, it's therefore allowed. All right, so it's pretty wide open. We're going to talk about there's 3 restrictions for IRAs and 1 restriction for 401k plans. But rarely is the investment going to be the problem. What causes problems for people in the space is transactions between or for the benefit of a disqualified party. And that's, as I mentioned earlier, with writing that purchase sale agreement. You've got to be careful on this stuff. So, and we'll get into the details of those 2 issues momentarily. So why do people look at these things? Why would anybody want a self-directed account? And really, it's a pretty simple answer. Typically, people take their IRAs and 401k plans and buy Wall Street's offerings. You're going to have your financial advisor there taking care of you, and you're going to be making these investments, and they're all going to fit in that space. And you're working on other people's advice, and you're working in a space where you're looking at a situation where your expectation is that whatever you buy is going to go up in value. If we're taking and looking at things that Wall Street does not sell, those things are typically considered alternative investments. Now, why does somebody come to us? Well, why do they want that self-directed account? Well, they want to buy something Wall Street doesn't sell. So not a traditional, but a typical IRA or 401k plan is going to lock you into Wall Street's offerings. And that's great, unless you want to go out and buy something that they don't sell. And people come to us when they want to buy gold, if they want to go buy real estate, which is the reason we put the business together. If they want to go out and make loans or buy notes, those things are possible. Crypto is possible. I'm not putting, stating my position on that or not, but I mean, if people want to do that, that's fine to do those things. But if we're looking at real property or precious metals, for example, what's funny to me is those things are considered alternative investments, and yet I would challenge anyone out there to name an older investment than either one of those. And why are those things, the oldest, most time-tested investments known to man, considered alternative investments, not real? So I call them real. Real investments, real property. But people come to us, they're tired of looking at the stock market's roller coaster, which really it's a result of the liquidity of those investments. I mean, if you don't want it, you sell it, and it's easy to sell and instantaneous. Real estate's not considered necessarily a liquid asset. So maybe the negative side of that is that it is not able to be sold immediately if you don't want it. But the positive of it is it's more stable. It's going to take longer. The swings are much longer and slower. Two, people come to us, they want greater financial control. They want to know where their money is. If they've got a checkbook IRA or solo 401k, the money's literally sitting in the bank, the establishment they want it in, and it can be right here in their community. They know the people they're working with right there. Everything's right there. Three, invest in what you know. If you want to take your money and put it into a Wall Street investment, and it's something you have specific information on, unless you're a politician, you can't use that information. So, that's one of those things where we all look at it, and it's a interesting deal. If you're a mortgage broker, you want to take your retirement account, make loans, you can do that. If you're a real estate broker and you want to take your retirement money, go invest in real estate, you can do that. And you probably have advantages based upon your level of knowledge in those spaces. So understand that you cannot use that specific knowledge in Wall Street. Well, you can use it on these self-directed accounts. Increased investment flexibility. Well, if you've got one of the accounts that's truly self-directed account, it's going to allow you to own everything you already own, plus anything else the law allows. So why wouldn't you want that flexibility? If you're looking at an IRA, I'm going to tell you, keep your Wall Street stuff where it is, keep it with your people, and then just move what you want to use in the self-directed world into the new 401, into the new IRA, because we're going to talk about the consequences of prohibited transaction in a bit. And it's important that if we're looking at IRAs, I think it's important to keep things segregated, because we're not going to have a catastrophic event for everything if it's a prohibited transaction. And I say that because if you commit a prohibited transaction with an IRA, all funds in that account are considered distributed as of the first day in the year in which the indiscretion occurred. Where if we're looking at a 401k plan, it's only the funds involved with the indiscretion that are treated as distributed. An example might be if you've got a checkbook IRA, and don't worry, but we haven't gotten to a full description of what a checkbook IRA is yet. But if you've got a checkbook IRA, the checkbook IRA has a debit card, and you go through McDonald's and you go buy a quarter pounder with cheese meal. Well, it used to be $6, maybe it's 12 today. But for that $12 indiscretion, because you had that debit card for the retirement account, if you use that for something you have, that's a prohibited transaction. You just blew up your entire IRA. If you did that same thing with a 401k plan, you just took 12 bucks out. So it's a big difference depending on what's going on, but that's an example of why it's so critical that we plan ahead and really start from day one. Hey, this is what I think I want to do, and really prepare for it. Get the account established, set up, ready to go. Anytime you make an investment with that self-directed account, you're going to think about what you're buying, what you're paying for, and who that transaction's between or for the benefit of. And you got to really be diligent looking at both those topics. All right. So real investments, not alternative investments. We talked about that. Community-based investing. What do I mean by that? Well, if you want to make a difference in your community, you can buy in your community. That's fine. The establishment that has your account can be right there in your community. So that's where if people want to make a difference right there locally, you can do that. The money doesn't have to go back to New York to get where it needs to go. Take advantage of today's opportunities. So you look at markets, you look at things going back and forth. And by the way, the self-directed account, if we're talking IRAs, it's not all or nothing. As I said before, I'm going to encourage you to keep your Wall Street stuff with your Wall Street advisor. Just move what you want to use in the self-directed world into that new self-directed IRA. The 401k plans, I'm going to say, hey, why pay for multiple plans? Let's move everything in the new 401k plan and reestablish the accounts with your investment advisors in the new plan's name. All right, new plan's name and EIN. But really, that's taking advantage of today's opportunities. Literally endless as far as the opportunities that are available with a truly self-directed account. Tangible assets. Okay, why do people like tangible assets? Well, they're great hedges against inflation. So most of the time people come to us, they're buying tangible assets, hard things, real things. All right, and then finally, security. What do I mean by security? Well, if you've got a situation with an investment with an unencumbered piece of property, how does that property ever go away? The only way it's going to go away is if you just stop paying your property taxes and the government at some point takes it from you. But it's not going to go away. It's going to fluctuate in value up and down. And I had unfortunately lost one of my great friends a few years ago, and he made a great comment. He says real estate's not a get rich quick scheme; it's a get rich surely but slowly scheme. And with one golden rule: don't get yourself in a situation where you have to sell in a recession. So you've got those time horizons that are out there, but the security, knowing that thing could never go away. I've got a buddy that financial advisor made a comment one time. We were at a breakfast meeting, and he says, if you bought Coca-Cola 40 years ago, it would be worth this. And I said, well, Mike, yeah, that's great. I understand that, but how many of those other companies could you have invested in the same point in time that are just not there anymore? So that's one of those things where it's important. Now, obviously, if you have an encumbered piece of property, one with a loan on it, and by the way, you can put a loan on an IRA or 401k owned asset, and we'll talk about that a little later. Obviously, if you don't make those payments, you could lose at foreclosure, and then you've got a total loss there. But typically, you're buying things with these self-directed accounts that they're tangible assets, and they're great, hedges against inflation and the security of owning that thing. And also, like I said, back that sort of community-based thing, the funds, when maybe they're just sitting in the account waiting to be invested, they're going to be in that banking institution that you choose to work with day in, day out. What are common objections? So I told you a few of the reasons that people come to us to do this stuff. And what do I hear as far as objections when we start working with these things from a client or prospective client's tax or legal representatives, or maybe their financial advisors? And so when we look at these are the four that probably come to the top all the time. And the first one is just loss of long-term capital gains tax rates. Well, why would you take a piece of your IRA or 401k and go buy real estate when you're not going to get the capital gains tax treatment on the sale of that thing ultimately down the road? And I would say, well, if you could only make the investment with money out of your pocket or the retirement account, I'm going to tell you to take it out of your pocket, because the idea is that the great thing about 1031s, the great thing about going out and buying a piece of property is you can swap till you drop, right? So it's like an IRA. It's pre-tax money growing tax deferred until you choose to pay the tax, or you pass away and the stepped-up basis occurs, and now yours get those properties with no tax exposure. So that's true. That's a wonderful thing. But sort of the fallacy of the statement is that there's nothing you can buy with an IRA 401k plan that's going to give you long-term capital gains tax treatment. So truly, the only real question is, what's going to be the highest, best use for that money? What's going to give you the best bang for the buck with your retirement account? The best return and the most long-term stability there, right? So that number one, you just blow it up because it's a pointless statement. You just got to be aware of anything that goes in that retirement account. And traditional funds are pre-tax money growing tax deferred. Roth funds are tax money that grows tax free. So anytime you're looking at a retirement account, at some point, that money has to come out. And at the time it comes out, it doesn't matter how long you've owned these things, you're not getting long-term tax rates. You're getting normal income tax on that thing. So it's really important. And as you get older, you're less concerned with how to get the money in the account, more concerned with how do I get it out with the least possible tax exposure. And we've got a couple of, sort of secret weapons in our space that I really, really like. All right. Two, why would you do this? Because you can't get leverage. Well, that's totally wrong. You can go out, as I said a few minutes ago, you can get a loan for an IRA or 401k. It's just got to be non-recourse debt. Well, David, what do you mean non-recourse? What I mean by it is that loan is not going to be attributable to your income, your credit, anything else you got going on, your assets. And in a foreclosure, let's say, they cannot come to you. You're not the owner of the property. The owner of the property is, legally speaking, it's a trust company for benefit of your IRA. So if you look at a basic self-directed IRA and you look at a deed on it, it's going to say, Susie Smith, or, it's going to read the trust company's name, CFBO, custodian for benefit of Susie Smith IRA, whatever it might be. All right, that's the way that deed would read. If you're looking at a checkbook IRA, for example, in that situation, the owner of the property is going to be the limited liability company, with the member being the trust company for benefit of Susie Smith. Susie Smith can be the manager of that limited liability company, but she's not the member. Now, could she be the member too? Could you combine retirement funds and personal money into a common investment? Yes, you certainly can. And we're going to talk about that in a while. Two different ways to do it. You can do it tenancy in common, or you can do it as common members of a limited liability company, and both have their ups and downs. But it's not a prohibited, it's a prohibited transaction to transact between or for the benefit of disqualified parties. It's not a prohibited transaction to transact along with a disqualified party. All right. So, with leverage, that loan, once again, it's not going to be something that, it's not you getting the loan, it's the retirement account getting the loan. You're not going to be a guarantor on that loan either. And by the way, if you go buy a piece of property, you're not going to put that property that the IRA owns or 401k plan owns, it's not going to be an additional asset on your insurance policy. It's going to be a new policy in that IRA's name or in the 401k plan's name, because you are not the owner. And I guess that's the best piece of advice I've got for you. Anytime you're looking at a retirement account and a self-directed account doing things, do not look at that as you. If you look at it as you, I think you're going to have a tendency to have some problems. If you look at it as Susie down the street, you're not going to take Susie's money. You're not going to pay for insurance. You're not going to be a guarantor on her loan, and you're not going to take her money, right? It's that retirement account, not you. And everything that happens with the retirement account, if there's a tax exposure to something that happens in the retirement account, it's the retirement account's tax obligation. It's not yours. So where it becomes your issue as soon as the thing's been distributed. And by the way, you could buy a property with a retirement account that you really like, and you say, well, at some point, gee, I want to personally own it. I don't want it in the plan anymore. Can I buy it? No, you can't buy it, but you can take that property as an in-kind distribution, which we'll talk about a little bit later. Number 3 here. What about RMDs? What are RMDs? First off, RMDs, required minimum distributions. So, at some point, you've got to take distributions by law, okay? If you're under a certain age, you don't have to worry about it, but at some point, you're going to have to take distributions. And, we're not going to talk about that age because the age changes every year or two, but I don't want this thing be date stamped and have bad information there. So you just talk to your, financial people, your tax people, what that age is at the time you're watching this and when you're going to want to take that distribution. But at some point, you got to take stuff out. So one of the arguments about a self-directed account is, well, what happens if you got to take an RMD? There's no cash in there to take the RMD. Well, now you're stuck. Well, far from the truth. You just simply take an in-kind distribution. And there's a couple of different benefits to that. One, what are things worth? And two, it is actually possible to take some discounting on that valuation if it's done correctly. And that's an item we'll talk a little bit more about in a while. Finally, why would you do it? You lose the interest deductions and depreciation. And, once again, that's true, but there's nothing you're going to buy with your retirement account that's going to give you those things. So really, it's a pointless statement, but it's one that I've heard over and over again argued against somebody when they want to go self-direct. So possible investments. So remember at the top, I said it comes down to two factors. What do you want to invest in and who you're transacting between or for the benefit of? When we're looking at possible investments, it's literally wide open. Unless it's specifically prohibited, it's allowed. The only things prohibited for an IRA to buy are collectibles, life insurance contracts, or stock in a subchapter S corporation. So rarely does somebody want to do that. And if it's not one of those, you can do it. So you name it, your IRA can probably purchase it. 401k plans can buy anything other than collectibles. So it is literally wide open. You're just buying something with the intent that it's investment purposes. Now you can go out and buy a business too. You're just going to have some other tax exposure. Not you, but the retirement account's going to have some tax exposure if you're conducting a business. Or another situation where you might have some tax exposure is if we're looking at a leveraged investment. The income or gain attributable to the leverage, the debt, is considered something that you're gaining a benefit by other people's money. Therefore, they're going to want to have some tax exposure on that income or gain that's attributable to other people's money. So one, what are you buying? Two, who are you transacting between or the benefit of? So any transaction between or for the benefit, excuse me, I'm gonna shut this blind real quick a little bit. So when we're looking at the transactions between or for the benefit of a disqualified party, those are prohibited transactions. So, who's a disqualified party to your plan? Well, you are, your spouse would be, your lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. Those are all disqualified parties. Sort of funny, I have to worry about sunshine in February in Oregon, and all my buddies in California are flooding away. Anyway, I won't digress any further. So you look at this stuff, lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. Now, as I said, you couldn't buy from, sell to, loan to, borrow from one of those, parties, or even, let's say, writing the offer on a piece of property. One of those parties has done it, you've got a prohibited transaction. Now, what's interesting is, did I say anything about siblings? No, I did not. Did I say anything about aunts, uncles, cousins? No, I did not. So even a sibling is not a disqualified party to your retirement account. So if you found something today that you had to write the offer on, have your brother, sister do the deal, and then when your account's established, at that point we can take over their position. So siblings fine, aunts, uncles, cousins fine, parents, grandparents, kids, grandkids not okay. Nor is any other, let's say, a limited liability company owned in a controlling interest by one of those people. So those two factors, pretty simple. You look at something, what do you want to buy? What is it? Does it fit with the exception of one of those three exceptions on an IRA, or one exception with a 401k plan? And then who are we dealing with? And that's going to dictate whether you can or can't make that investment. It's that simple. Not complicated. It's that simple. All right. So when we're talking about prohibited transactions, what are sort of the biggest issues that come up? Examples of most common prohibited transactions: assignment of purchase sale agreement from taxpayer to IRA LLC. We've talked about that. I'm not going to talk about it any further. A recourse debt, if the lender is making a loan to your retirement account and they have the ability to come after you, that's a prohibited transaction. Contributions, distributions directly between the IRA LLC and account owner. David, what do you mean by that? So when we get a couple more pages up, we're going to talk about the structure of a checkbook IRA. But in a nutshell, you've got a limited liability company, as I said at the top, with its member being the trust company. And that limited liability company is going to have a bank account at the bank of your choice. You're the manager of the entity, so you're going to establish that account. The account's under the LLC's name and federal tax ID number, and you, as a manager, managed LLC, and you're the manager of that thing. So let's say you want to make a contribution. Well, if you write a check simply to the LLC, that's not okay. It needs, that contribution needs to go from you through the trust company, then they're making an additional investment in the LLC. So it's got to go from you through the trust company to the LLC. A distribution has to go from the LLC through the trust company to you. All right. If it goes directly, that's a prohibited transaction. We can't have that happen. Okay, working on the IRA-owned asset. So we have lots of people that have their whole life, they've worked with us maybe on 1031s, they work on the properties, and now we do a self-directed account for them to go buy stuff. They're used to working on it. They can't. Okay, you cannot work on an IRA or 401k owned asset. You can manage the asset. You cannot go out and, we say, get dirty on it. So don't pick up the paintbrush and do it. That's not okay. Don't fix the plumbing. It's not okay. Those are all prohibited transactions. All right. Using the IRA-owned asset. Don't, by the way, 1031, for example, domestic property for domestic property, foreign for foreign. If you want to take your IRA 401k and buy foreign property, you can do that, but don't think, hey, I'm going to go buy a property in Mexico and I'm going to go use it. You cannot use the property, nor could any other disqualified party. And I just mean period. All right. So don't buy a condo downtown for mom to live in. You can't do that. All right. Finally, use of taxpayers' personal insurance policy. As I said earlier, I think this is one of those situations comes up a lot. Somebody will buy a property and they just talk their insurance, broker agent, and then they go and add it as additional asset in their homeowner's policy, which it's not. It's got to be a new policy in the plan or LLC's name and EIN. Okay. So as I said at the beginning, the best way to look at anything owned by your retirement account is to consider it someone else's. And I really think that's the best way to look at it, because it's going to keep you clean. Where if you start thinking it's yours and you're going to work on it, you might. And another question that comes up a lot of times is, well, gee, I bought the property in Texas. I need to go look at it, or I need to go check on it, kind of right off the trip. No, it's not yours. It's a retirement account. You take money out of that account. Any money flowing from you into the IRA or into the 401k plan or out of that entity to you, unless it's a contribution or distribution, is a prohibited transaction. So it's really important that you're looking at those things and understanding that. And as I said, if you've got a Wall Street portfolio and that's all you've got, you really don't have an opportunity to create a prohibited transaction. Where in my world, you've got to be diligent, because, and these are just not right for everybody. You've got to be really on top of it and diligent to make sure you're keeping things in compliance, and that way you're going to be just fine and they work great. But you start sort of blurring the lines, you want to go work on stuff and pay yourself for things, that's really, it's a prohibited transaction. It's going to blow up the account. So can I do this? Can I work on a property owned by my retirement account? As I said, no. Can I guarantee a loan from my retirement account? No. Can my business occupy a building owned by my retirement account? Once again, no, unless you own a minority interest in your business. I guess that would be an example. Can I write off expenses for travel, etc.? Once again, no, it's not yours. It's the retirement accounts. So what kind of property people want to buy, or what can they buy? Rental houses, apartment buildings, office buildings, retail centers, land, any property acquired within, for investment purposes. A future retirement account, home, yes, you can do that. You go buy a place at the beach. It's sort of funny, actually. I had a buddy in here. We were filming a webinar on mobile home RV parks a couple days ago. And I said, Mark, why is it that, for example, I'm sitting here talking to you from Portland, Oregon, and if you go, let's say, up to the Columbia, you look at, Barry King Graymore's beautiful qualified opportunity zone project on the river up there in Vancouver, and you sit there and you're sitting in DeSalis or one of those restaurants and having a nice lunch or dinner. You look across the river, that big mobile home park's right there, all that waterfront. And we were talking about, he's from Southern California, I'm from Northern California, but you talk Santa Cruz, we've got a bunch of mobile home parks that are right there on the water, and SoCal the same way. And we're just laughing about all that. And I said, Mark, how'd that ever happen? He says, well, because nobody wanted to live on the water in those days. It was cold, it was foggy, it was windy, and da-da-da. And, life has certainly changed. But, you know, so you look at this stuff, a future retirement home. Could you take your IRA 401k plan and buy one? Yes, you can. You just can't use it until it's been taken as a distribution. So what's going to happen is that property is going to be used for whatever purposes you want to VRBO it, whatever you want to do, that's fine. It gets to a point where you want to start using it personally, it's got to be taken out fully as a distribution before you can use it. You can't buy the property from the retirement account. That's a prohibited transaction. So the only way you're going to get it is by taking distributions. And you can take it all in once. And what you just took a distribution of is all the equity in it, or you can take it over a period of time. If you take minority interest distributions, it may be possible to actually discount those valuations too. So it's really something that's there, it's possible, you can do it. So things you cannot do: you can't buy a primary residence, can't buy a second home, can't buy a home for a disqualified party, and you cannot buy, once again, that office building to be occupied by a disqualified party. So, you know, we've talked about what you can do, what you can't do, what you should do, what you shouldn't do. Now, how do we do it? All right, so if we're looking at creating a self-directed IRA, it's pretty simple. Okay, if it's a basic account, and so I'm going to clarify something right now. A basic self-directed IRA means that you're going to establish a custodial account with a trust company that does self-directed investments. And that's it. You're going to establish the account, fund the account, and then the owner of any investment you make is going to be that trust company for benefit of your IRA. So to buy that property with a basic account, you're going to have to submit the investment to the trust company. They're going to have to approve it. They're going to then fund that thing. And it's going to be all the details of the investment. There's going to be a prohibited transaction form, a variety of different forms that have to be there, and there's certain rules on what they're going to require to make this thing happen. And the rules vary depending on what trust company you're working with. But everything flows through the trust company. If there's a repair that needs to be made, the trust company is going to make that repair. When you sell the property, listing agreement is going to be between the seller and the trust company, and the property goes away, the funds going back in the account. So that's a basic account. It's a checkbook IRA is something that allows you to manage the asset, allows you to negotiate the purchase or sale, whatever you want, when you want, as you want, without the trust company's involvement. The checkbook IRA just simply means that after we've created the basic custodial account, the investment the trust company makes is in the membership interest in a limited liability company that you're the manager of, and that entity then has that bank account, the bank of your choice. And then when you go to buy a property, you're just going to negotiate between the seller and that IRA LLC. If you've got a 401k plan, you can do it a solo K or solo 401k. You're the trustee of that plan. The plan can be the direct owner, or you could have an LLC with the plan as its member. Either way, it's just fine. But checkbook IRAs and solo 401k plans work the same way. You've got total control of what you want, when you want, as you want. Where a basic account, everything has to flow through the trust company. That's the difference there. Honestly, you don't even need us for a basic account. I mean, people pay us for basic accounts all the time because they're sort of, you know, confusing when you're putting the things together, and they want our advice, and so we get involved with those. Typically, a trust company's not going to do what we call a checkbook IRA or an IRA LLC. That's when you need us. And then, you know, the 401k plans, once again, really, it's just, you're looking at 401k plans. It's just a question of, if you come to me and say, David, I want to take my 401k plan to go buy some, first question I'm going to have is, well, let me look at the plan, see if it allows the investment. If it allows the investment, then fine, use it. If it doesn't allow, can the plan be amended to allow the investment? Or, you know, do you have a TPA, third-party administrator, that's going to allow the investment too? Or maybe we have to replace the plan. So it's a little bit different. We'll talk about 401k plans more in a little while. But really, when we're looking at this process, most trust companies have online application forms. You can just fill them out and do it all yourself and take care of it. You can have online access to what's going on. Some trust companies you can call and they actually answer the phone. Other trust companies you're going to call and you're going to sit in a queue until somebody answers the phone. But, you know, really it's just there, and they're going to help you establish the account and then give you some, you know, basic advice on what you can and can't do. But as far as like IRA LLCs, checkbook IRAs, they're not going to do those things. So that's a pretty simple process. Getting the account established might only take a day or two. What takes the time is moving the money, because you've got to, if we're going IRA to IRA, one of the forms that's going to be filled out after the account's been established, or as the account's being established, if you're going to fund it with the IRA funds, is there's going to be a transfer authorization form that needs to be filled out too. And that form allows the new self-directed custodian to go to your current custodian and say, give me the money. And as I said at the top, it's not all or nothing. And then with IRAs, I just move what you want to use. Don't move at all. Because inevitably you'll have money sitting in an account that's not doing anything for you, and you're probably going to want to establish an account in the, if it's a checkbook IRA, for example, the money would flow from where it is in the new trust company into the LLC, and then you'd have to go reestablish a trading account or investment account with your investment advisor, and then everything's in that LLC, and everything's encumbered by what you're doing. Where I like it better, if we're just going to leave the Wall Street stuff where it is, move what you want to self-direct into that account, and then if there was a prohibited transaction to happen at some point, only the money in that account is encumbered, not your Wall Street stuff. So that's why I like segregated accounts. When we're talking about IRAs, 401k plans, we don't have to worry about that. This is a checkbook IRA or IRA LLC, all right? And so if you look at the left side, going to the right, the left side, you're sourcing that self-directed custodial account. So whether it's a basic account or a checkbook IRA, IRA LLC, we still have to establish a custodial account. The difference is we're going to flow any number of those accounts into their respective custodial accounts. The custodial account then makes the investment in the new IRA LLC. And that, so basically it's going to flow like this. We're going to establish the custodial account. The money's going to flow from your current custodian, investment advisory firm into the new custodial account, and it's going to be there for a day or two. And then the trust company, the new self-directed custodian, is going to make an investment in the LLC. So as the money's moving from custodian A to custodian B, we will have created the limited liability company, the operating agreement, articles of organization. And the operating agreement, by the way, is very specific. Do not think you're going to go out and get an operating agreement that any trust company is going to accept. And they're not going to do it unless it's specifically IRA conformed. It's got to be specific there, and they just won't accept it. And I've got a story for you real quick. We had a client years ago, very successful woman, and I know her. I know the way she is. She's not very patient. She wants do things when she wants to do it, and that's why she's so successful. So it's not a knock, it's a compliment, honestly. But we're putting this custodial account together for her because she was going to loan the money to another partner. Then they were going to be working on some investment houses. And I told her, I said, you're not going to like a basic account, because I knew she just didn't have the patience for it. So what happened is, I said, we'll do a basic account for you, then you can come back to us when you want the other. She didn't want to spend the money on it. And just since we're on that topic, a basic self-directed IRA, we're going to charge you $500 for. I mean, you can go do it yourself, and maybe for $100 if you want, but I mean, it takes time and manpower, so we're going to charge you something for it. A checkbook IRA is going to be $2,300 one-time fee. And then ongoing costs, you've got the custodial fees, depending on if it's base account, just custodial fees, it's the management of the thing. If it's checkbook IRA, you're going to have LLC registration fees, maybe registered agent fees. You're going to have a review that may or may not be required depending on what trust company you're working with. And then they're going to have different rules for who can be the manager of the LLC depending on the trust company. So it's really important you're working with the right trust company if you're doing IRA LLC or something. But anyway, in this gal's case, we did the basic account, and sure enough, 6 months, a year later, she was frustrated with it because she didn't like dealing with the trust company every time they were funding another loan or making an additional acquisition. So instead of coming back to me, she went to her lawyer and said, oh yeah, I can put an LLC together for you, no problem. $10,000 later, she had an LLC that was unacceptable for the trust company. So they came back to us and we ended up putting it together. But it's very specific. You're not going to get that thing done by somebody that's not somebody that's worked in that space. So just be aware of that. Don't pay somebody to learn on your behalf. Pay for somebody to get it done. All right. So that investment in the LLC happens. As the money's moving, you're going to put the bank account together. The investment in the LLC happens, funding the bank account. And at that point, you're sitting there as the manager of the LLC, ready to make whatever investment you want to make just by writing a check or negotiating between the seller, the investment provider, and the LLC, and you're the manager, and you're going to wire the funds, write the check. Any income from those investments is going to go in the LLC, any expenses paid out of the LLC, and it's a very, very streamlined, great process, and allows you to make time-sensitive investments, to take advantage, negotiating those purchases directly without the time that's required to run through and get the custodial's approval on everything that's happening there. And a solo 401k really works the same way on that. Something I want to mention, and remember earlier I talked about disqualified parties, and I said you couldn't transact between or for the benefit of disqualified party, but you could transact along with. So if you look at this page we just sort of talk about, the membership of the limited liability company. It doesn't have to be a single member entity. And we've got many people that maybe are retired and will have his IRA and her IRA in there as members of the LLC. Well, something I didn't mention, disqualified parties, not only you and your IRA, but a traditional IRA and a Roth IRA. If you've got those, both are disqualified parties one another. Well, you can combine traditional Roth money in the LLC. You can have your personal money and retirement funds in the LLC. You can have yours and your spouse's funds in the LLC. Any combination is going to be fine. But if we're combining disqualified parties into that new IRA LLC, what I'm going to tell you is it's really critical that you have enough in there to make those investments that you want and cover any foreseeable expenses going forward. If more money is needed in that limited liability company for something, if you bought a property and spent all the money on acquisition, now you got a roof that's bad, you need $50K to fix the roof, you got a problem, okay? And because the investment in the LLC by all those disqualified parties is fine at inception, but any future transaction, unless every member is making contributions pro rata their initial investment, that's a problem, okay? So once again, if you have to add money after the initial funding of the LLC, everybody that's a member has to contribute their pro rata amount. If your retirement account puts 10,000 in, you put 5,000 in, and that was the ratio at acquisition, that's fine. But if that was not, if you each put 10 in at time of acquisition, the first investment in the LLC, and now you're putting in different amounts, that's a prohibited transaction. So it's really critical, once again, that you plan ahead. You look at this thing, hey, what do I need in this? Overfund the LLC, that way you're not going to be running into those issues going forward. Oh, we're running out of time. I've been having so much fun. I haven't looked at the clock till just now. All right. So can we get an IRA? Yes. We've talked about this. I'm not going to take a lot of time on this page. It's just got to be non-recourse debt. You're not going to go fill out a form with a national bank that's going to give you that loan. It's got to be somebody that specializes in it. You can take a look at myiralender.com, iralending.com, North American Savings Bank. Is somebody we've worked with for many years. They wrote a book on loans and IRAs, and it's a good book. And you can call them up, and they'll send you one. But anyway, you're going to have to work with a bank that typically a portfolio lender that understands what's going on, and they're going to be somebody that's going to be compliant in this non-recourse IRA 401k specific type of loan. So don't think you're going to walk into the big banks and they just simply don't have a box for it, and start talking about what you need. They're not going to give you the loan. And one other comment too is I love credit unions. I use them, personal accounts with them. But if we're looking at a bank account for the IRA LLC, they're not going to open that account because the trust company's, legally the member of it, the trust company's not going to, apply for and open an account with a trust company, or not a trust company, I'm sorry, with a credit union. So just be aware of that. Typically, we establish these accounts with regional banks. Somebody you can actually go and sit down and talk to, and they'll take care of it for you. So solo 401ks, if you're self-employed without employees, the 401k is great. I mean, really what we're going to do is provide you a plan. It's federal tax ID number. You're going to open a bank account in the plan's name and EIN, tax ID number. You're the trustee of that plan to make an investment. It works just like that IRA LLC. You're just going to negotiate the purchase between the seller and the 401k plan, and all the yield off the investment goes in the plan's account, any expenses paid out of it. And you know, when you sell, funds just go back in the account. The nice thing, and actually, you know, if I go back, somebody didn't mention here, but it's really important, is that, you know, it's got to be non-recourse. You can't have a disqualified party be the guarantor there. But income or gain attributable to leverage. So I said it earlier, I'm going to say it again. If you've got an IRA and you go out and get a loan, 50% loan to value on a property, 50% of the income is going to have tax exposure, and 50% of the gain upon a disposition is going to have tax exposure. So there's actually situations, if I go back, you know, 20 years, 25 years ago, there's a guy that before we were, actually it's more than that. I mean, it was probably in the mid 90s, I think, when we had, I organized a presentation from this trust company and this gentleman that was in that space on self-directed accounts. And, you know, he was basically trying to sell his investments, but you know, the issue that comes up here is that you've got to look at, you know, I'm not saying having tax exposure on leverage is a good or bad thing. You just got, it's an additional item to factor into your ultimate ROI, return on investment. Your yield is going to be impacted by that. But the reason I bring up that gentleman is he was trying to sell IRAs in opposition to 1031. They're apples and oranges, two different things. And there's actually situations where even with a Roth IRA, you take a Roth IRA, you say, hey, it's tax money growing tax free. I don't have any tax exposure or anything I do. Wrong. If you're doing a self-directed account and you've got a leveraged investment, you're going to have tax on the leverage. Or if you're conducting business with that IRA, an example might be you buy an apartment building, it's got a laundromat in it. The laundromat's one component of that investment. Now you say, gee, the laundromat's great. I'm going to go out and buy a laundromat with my retirement account. Now you're conducting business. So you're going to be subject to that UBIT, unrelated business income tax or taxable income. And that's what bites you on that income or gain attributable to leverage. Where if we look at the 401k plans, you don't have tax exposure on leverage, which is a huge thing for people. All right. So why do we like these things? You can't migrate Roth money or beneficiary IRAs into the 401k plan, but the 401k plan can, after you've established it, have Roth component and traditional. Your contributions are the max you're going to have short of defined benefit plan. No UBIT on leverage, no custodian required. You can invest in anything other than collectibles. And the other thing, you cannot borrow from an IRA. You can borrow from a 401k plan, half what's in it to a max of $50,000. So we didn't talk about, but the IRAs, you know, really your annual reporting, you're going to have to provide valuations to the trust company annually, and they're going to do whatever paperwork's needed. 401k plans is a $5,500 easy that's going to be there if you've got funds in excess of $250,000, so you can have valuations there. If you're a broker and you sell somebody a property and with their retirement account, I'm going to tell you that investor needs to have valuations annually. So if you're going to really take care of them, ultimately taking care of them takes care of yourself. But you're going to provide them the annual valuations for those properties. Broker's CMA is going to be fine unless they're taking a distribution of the asset in kind. Then you'd probably have an appraisal done. So, you know, typically the annual valuations for a checkbook IRA, the trust company has no idea what you have in it. So they need somebody to tell them, you're going to fill out a form with the trust company annually telling them how much, you know, what you've got, how much the value of your IRA LLC is, because they just don't know. There's no way for them to know. And you know, 401k plans, you know, same situation. So what I'm telling you as a broker is every year, they're going to need a valuation. You're the person that gives them the valuation when you go to sell the property. If you've taken care of them, you know, hopefully they're going to use you to list the property. So it's just, you know, one, you're taking care of them. By taking care of them, you're also going to be helping yourself at the end of the day with that, maintaining that relationship. Don't look at it as a transaction. Look at it as a relationship. All right. A few examples, we're done. So this one, This is a situation, actually, let me go back before I get in this. So I made a comment earlier. So when we're buying the property, if it's a checkbook IRA LLC, you're just going to write the offer between the LLC and the seller. If it's a 401k plan, it could have the plan could buy into an LLC that then does it, or the plan can be the buyer. So if you're the broker, you're either writing the offer between the seller and the IRA LLC, or if it's base account, the seller and the trust company. If it's a 401k plan, it could be between the seller and the 401k plan, or the seller and the 401k plan's LLC. Any of those things are going to be fine. When you go to sell the property, same thing. Once again, you're not going to write a listing agreement between you and that technical taxpayer. You're writing a listing agreement between you and that IRA, the trust company, or the IRA LLC, or the 401k plan, or the 401k plan's LLC. And when that thing sells, the funds are just going to go back into whatever type of account it is, directly into those accounts. So those transactions, you're not working with the manager. You're working with the manager in a manager's capacity in an LLC, but you're not, that manager's not the owner. The owner, legally speaking, with an IRA LLC or checkbook IRA, is going to be the limited liability company with the trust company as its member. So it's really important to keep that in mind. So this is an example. Somebody came to us, and this happens all the time. People call us up, can I do this? Can I do that? And ultimately they might take a whole different direction on things. This gentleman, great guy, he came to us, his first question, and he wanted to go out and buy a mobile home RV park, and we went through the stuff. And ultimately he called up like the next day and said, hey, can I buy notes? And certainly you can do this. This was actually back in the last recession. And this is a property in Palm Desert. I mean, we all, if you didn't buy anything during that time, you certainly missed the bus. But this was property that was worth $200 to $250 pre-crash at the time, and this was a transaction where that condo was selling for $70,000. This gentleman had a mortgage broker, a good friend down there, and so he was going to buy a note, paying him 11%, 50% loan to value. So in that situation, he was very happy. So a lot of times people come to us, they sort of dip their toe in the water. So he started off with, let's say, $100,000 funding. He ultimately put a couple $1 million in his retirement account. Very successful guy. And I think the best investment he ultimately made was it was a wind power deal, where I think it was a $20 million project, and they needed 900,000, and it was paying them, I think it was 19%, I want to say. So he was sort of cheering them on to default so he could own the whole thing. But in this situation, he was a guy that had income properties, tired of the terrible teas, toilets, trash, tenants, turnover, didn't want to deal with it anymore. So that paper was a great solution for him, and that's what he did. This is an example of somebody that the first call was, hey, I need some more income. So he wanted to go out, and he was sort of unsure what was going on with the securities world, and so he wanted to go out and put his money into an apartment building, and in his words, he just needed the additional cash flow. And so back to my comment earlier, don't think of it as you. It's a retirement account. The only way you're going to get the benefit of that investment is by taking distribution. So I'd say, no, look, the cash flow is not yours. It's the retirement accounts, but you can take cash flow as you choose via distributions whenever you want. So keep in mind, if you're under 59.5, you take a distribution, you've got normal income tax on a distribution, 10% penalty. So as soon as you get 59.5, you can take those distributions, you look at normal income tax on it. So that works pretty well on those things. So in this case, we got the deal together, put it together, got him on track with his understanding of whose benefit's going to be there and how he was going to get it, and that's what he did. So this example is sort of extreme. It shows what is possible. So this older couple came to us, and their first comment was similar to the other one, where, hey, can I buy a mobile home RV park? And the answer was yes. And I said, okay, well, we'll just do a checkbook IRA, retired couple, his and her IRAs. We just do a multi-member checkbook IRA LLC and put each of them into it. And then as we talked to them, they went further. They said, well, no, well, we want to be the on-site managers. We want to live there and manage the asset. Well, okay, we can't do that. Both those things would be prohibited transactions. If you're being compensated in any way for management, that's a prohibited transaction. If you're living there, that's a prohibited transaction. Okay, well, don't worry, you're not stuck. So we shifted gears entirely to an entirely different process. So instead of using IRAs and limited liability companies, we shifted gears into 401k plans and C corporations. So that combination is something called a ROBS, a rollover business startup. And once again, you can't use IRAs or LLCs for this. It's got to be specifically 401k plan and a C corp. So what we did is we created the 401k plan, we created the C corp for them, and the plan bought the corp bought the part, and now they were employed by a corporation and had a home by that corporation. They had an investment, a place to live, and a job, all with that one transaction. So we've used rollover business startups for everything from car dealerships to mining operations, believe it or not, Alaskan fishing operations, all kinds of things through the years. The mattress companies, gas stations, the franchise world has really sort of figured this out and drives a lot of business that way too. But it's, never say never. The only dumb questions one you don't ask. Call up, ask the questions when you're thinking about doing these things. We're happy to talk to you about it. So sort of investor's checklist. Plan ahead, takes 2 to 4 weeks to establish the account. You can purchase all types of product with an IRA, SEP IRA, Roth IRA, 401k plans. Purchase with family members, friends, can't purchase from or for them. IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage. Negotiate from the deal's inception the IRA, IRLC, or 401k plan's name. Do not overextend. Plan on keeping a nice cushion of reserves, because whatever that thing is, if you spend all the money on the purchase and then something happens, you don't have the money to fix it, that's a problem. So, keep these things in mind, plan ahead, and you're going to be just fine. And really, every time, if you've got a checkbook IRA or you've got a solo 401k plan, anytime you pull out that checkbook, what am I doing with this check and who is it between or for the benefit of? And that's going to drive those transactions. Thank you so much for the time today. There is a glossary after this page. If you want access to this deck, we will send it out. If you are in Oregon and you want a credit hour for this, it is compliant. We can provide those for you. Email cmoore, M-O-O-R-E, at 1031exchange.com, and Celia will get that information to you. If you got questions, once again, post those questions. And if you want that slide deck, please let her know. Thank you so much for the time today. If you've got questions or concerns, give us a call. We're happy to talk to you anytime. And our goal is to keep you on the rails, give you the opportunities that you're entitled to, and help you live the life you want to live. So thank you so much for the time today, and I look forward to talking with you soon. David Moore, IRA Advantage. Bye-bye.